Hi, this is Randy Finney with Right Side to the Chart, and today is Tuesday, January 17th, 2023. I wanted to get a quick update out. There's really not much of a change in many of the things I've been watching, but figured I'd do an update on the usual suspects. We'll start with the equity markets, touch on commodities, particularly crude, natural gas, make a quick update on lumber, and maybe treasuries. We'll see how it goes, or gold. Maybe we'll do that too. We'll see. Let me keep it relatively brief. And really, I wanted to start out here with these equity markets, the Qs, I should say, which for all intents and purposes are still at resistance. Remember that 280-ish target right here. It's more of a zone on the daily. When I flip over, that was a 60-minute chart where we're just looking at, but you have this big support level back here, and somewhat of a range. You have quite a few reaction highs at the top of the range, runs up to about 284. But again, we're at 281 right now, 281.34 versus the the resistance on the 60-minute chart was 280.16. That's we're talking hair over 1 point on a nearly 300-point security, so that's a fraction of 1%, and so that's it. So we're right there. And this is day 3. Remember, we hit that target on Thursday, and then we hit it again on Friday, and we were testing pre-market. I suspected they'd probably want to ramp it up today, but they did, but not by much. So really, like, again, for all intents and purposes, we're still trading, at right around that resistance level. And the divergences that we had last week are still there. They're just a little bit larger. And what we could probably do now, there's that wedge, the uptrend line we had last week with a little whipsaw down through it. We can probably add another trend line. Yeah, we definitely can at this point. Yeah, it's nice and clean as well. So that's what we need to watch. Now I'll say that the Qs are resilient. I got an alert right after the open this morning on Tesla. Tesla broke out. That's the only one I didn't throw away. Took profits on Amazon and Apple last week. Had some Tesla, took profits on my Qs, and I'm still short the Qs. But I'll tell you, there's a bid right now, despite these technicals. Normally, you'd see, especially in a bear market, you wouldn't see us flirt around with resistance so much after an extended run. This is now, when you look at the QQQ daily chart. Let me turn off all my lines here. We have, I pointed out last week, we had at that point in time 6 up days, 6 green candles in a row. Today makes 7. Again, the odds of us closing based on those divergences and everything else, another green day is pretty low. We have not had 7 consecutive green days, positive days, since, as I mentioned before, that same time period I highlighted. That was at the very tail end of the last bull market. It was right here in October into early November, and that was, again, the last time. Really, we hadn't had, up until that point, I think the most we had was if I counted right, 4 green candles. So, we'll see. It's nothing set in stone what has to happen, but there's that resistance level right there. Let's look at the other indexes. And so, again, I think we'll get a pullback here based on the technicals, if nothing else, and I'm still kind of focused short term. So just jumping back to QQQ, there's our uptrend line 60-minute chart. And now, since we've slightly eked above that 280-ish level, again, a little bit above 280, if we move back down below it, two things are going to happen. You're going to break down below this, what I call BOD, or benefit of the doubt, secondary trend line that's now set up. There's enough reactions there to validate it. So that'll be a sell signal there, and then a solid move back below 280 will make this prove to be a whipsaw or a false breakout, and therefore, again, minimum target is just above that 274.81. That was a target on the way up. It was resistance. Resistance, once broken, becomes support. And we'll see what happens from there. I wouldn't be entirely shocked if these overbought conditions on the shorter term charts, on the 60-minute charts, work themselves out in a correction in time more so than price. I favor the pullback, but like I said, today really should have been the day, if not Friday, that we started to move down. So, and there's a lot of people seeing what we saw down here, the reason to go long, thinking the worst is over, they're buying here. So that is possible. Don't get married to a short trade. Because the longer you move sideways and consolidate on this area, the more you work off the near-term overbought conditions. But again, I favor it. Minimum a pullback there. just above that 274.81 level, and well, we'll go from there. If we go up more, I think I mentioned before on the 60-minute chart, at least about 285.60 is the next resistance, and then on that daily chart, same thing at a zone. And then the big levels for QQQ are the 200-day moving averages, which come in together, the exponential and simple, as well as the primary downtrend line. That's this line right here. It comes off the bull market highs, beginning of the bear market. And then also you have some nice price resistance. This trading range that I'm boxing in right here, which we're at the bottom of now, the top of that range comes in around 294.20. So that is a massive, in my opinion, confluence of resistance. And so, you know, if we do drift up before we get a decent correction, that would certainly be both a an objective level to book some profits on longs and or take some shorts. Again, if the charts are confirming, ideally you want to see the divergences, you want to see the market leaders at resistance at the same time, and you want to see the S&P 500 there. Now, the S&P 500, busy chart here. I'll turn off all my lines and just kind of highlight that primary downtrend line. So that we have tagged. So the S&P 500 is right now trading at that comparable big time resistance level I just showed you on, that's still overhead a little bit on QQQ, which is the same thing. You have the pinching together the 200-day moving averages. That's the blue line and red line. The blue is the simple moving average. The red is the 200-day exponential. Some traders watch some watch the other. That's why I watch both, and all the better when they come in together. So you have the S&P 500 there. You have the primary downtrend line also just a hair above as well, so close enough to get a rejection. And again, this is since the bull market ended. That was the end of the great bull market, the great Fed-induced bull market off the 2008-09 lows, one of the biggest in history. And we're looking at what is still by just about every metric a bear market. And so, as I've mentioned many times over, the stopping points for every bear market rally so far have been both the downtrend line and in relative close proximity the 200-day. Sometimes the Nasdaq 100 hit the 200-day. The S&P got there above that. Remember, the S&P was outperforming this. The story of the bull market of 2022 is tech, and the market leaders getting taken out and shot. Big tech took the market down the hardest, and so that's why the Nasdaq 100, as expected, and that's why that was my preferred shorting proxy, outperformed to the downside, meaning fell quite a bit more. And then on the rallies, the S&P went up more because they still weren't buying the big overloved, overowned tech stocks. And therefore, that's what I'm getting at, is sometimes you have the S&P run at the 200s, go a little bit above, and then the Nasdaq hits resistance after that, and that's where you get rejected. But either way, close enough proximity. You can see all the levels there, the downtrend line, and that was the 200 simple. It hit perfectly with the downtrend line. Hit them again there, pull back, tried to break it out, broke out above the 200 on a single day basis, but then rallied right into the downtrend line. So look, all I can say is it would be very hard to argue the significance of these levels, and we could pop it. One thing to note is usually in early on a bear market, or if the bear market still has a lot of life left in it, you hit it and then you get a big down for quite a while. To see us come back, we hit it here, got a little rejection, back up. Here, a little bit bigger one. We were able to short that and then get out of our shorts and go long here and game this. But I will say this is showing some resiliency here, because normally you would see that's it. Once you've come back and you haven't visited in a while, here, usually you get that. So I'm being open and flexible, and I've given you some upside targets on the big fangs in the Nasdaq 100, and that's certainly a possibility. And that's hence the reason I'm in short-term mode. I don't have a strong opinion on, let's say, 401k positions, swing and trend positions right now, because I could make a decent case, although that case is going to go up substantially if the S&P can clearly take out those levels. But again, it's not even then an all-in if the S&P takes those levels out, the 200 days in the downtrend line, because you have QQQ lagging behind. And then if that happens on the S&P 500, well, you may see the Qs hit that level. So what all I can tell you is if and when that happens, and then QQQ takes out the downtrend line and clearly takes out these 200 days, and starts walking away from them, maybe back test, that's going to be bullish. Otherwise, the MO has been pretty simple stuff. Short rallies. There it is, the 200-day. That's the one I was talking about a minute ago with the SPY, where SPY went quite a little bit above the 200 days, but we got a perfect rejection off the 200-day in the downtrend line on QQQ. That was the simple, the blue line. Then here we got rejected off a hair above the 200-day exponential, a little bit below the simple and the downtrend line. And then there, not shown here, again, I highlighted it many times, that morning in pre-market, got a post out to you, we were trading right there, which is both the downtrend line and the 200-day moving averages. That was a golden shorting up. A very easy one, too. Like I said, three of the most important resistance levels in the bear market. And so that's what we'll watch. I think we're going to get the pullback first, maybe get another thrust up run at them. Maybe not. It is a bear market, and just because we didn't tank the last time we hit those doesn't mean that we're not zigzagging our way down. Remember, if you look at it this way, turn off all the lines here, the markets, especially the tech-heavy Qs and all these market leaders, are in a very precarious position. They're still relatively close to new bear market / 52-week lows right there, within spitting distance. What I mean by that, we've had 7 green days so far. Again, today's not over, but you can see when the market turns, it can go down. That's just a few days right there, less than a week of price action. There's 3 days right here. 3 red candles took us that far. So just stay flexible and react if you are bullish and targeting more upside. Don't get married to that scenario if this starts to happen. And if you're likewise, if you're bearish, don't think that just because we're below the 200s and that we can't take them out. So that's it. Let me cover the market leaders, then I'll get to a couple other things and we'll wrap up. Keep the video relatively short. All right, and the big dog is of course Apple. And I know I have so many lines on the chart. I'm going to jump down to the 60-minute chart. That's the one I've been highlighting on recently. There's an uptrend line right there, comes off this June low. We really had this triangle pattern, right? We broke below it, and now we're back testing it from below. There's also some price resistance there. And when I go to the 60, we are a little bit, but again, not too much above the wedge or I'm sorry, really it's this level. That was what I was targeting right there, the initial target, 134.61. That's where I took profits on Apple last week, and it is above it, but it's not really taking off, again, because it is quite a bit overbought, and the markets, most importantly, are at resistance. I'm going to tweak that uptrend line right here to kind of come in and capture. This is how it should now. It fits a little better. We have several reactions on it right there, and that's just our divergence line. So we still have what we had last week. Again, that's why I haven't really done any other updates than the one I got out to you in pre-market, because there's really no change. We're trading just a hair fractionally, above where we were on Thursday when we hit those targets, and again on Friday, and there we are today. And so there it is. So boom, this would be a sell signal on Apple to drop back below the trend line in 134.61. Otherwise, as I did lay out back, when I bought it back here, we had the bullish falling wedge breakout and back test right here. 60-minute bullish falling wedge, breakout, back test, objective entries, and I said this is, and it still is, very much a potential target. There's the downtrend line on Apple off the October highs right there on the 60-minute chart. So I have really 2 variations. I have this one comes in first, it's a little more conservative, and then that one that captures these highs right there. So possible, and if we burn through these divergences and keep moving up, you're talking anywhere from another, it's not much, 3-4% upside in Apple, and that's a pretty significant level there too, that downtrend line. So when we get there, that's a likely reaction point, reaction being a consolidation or pullback. Let's look at the others. Microsoft, again, that's one I didn't take. I took Apple, Amazon, and Apple, Amazon, and Tesla. And again, the only one I still have now is Tesla. Alphabet, there's your downtrend line. See, all these stocks have these trend lines, which to me look like they want to be visited. And so that gives us a little more upside, not much. When you look at Alphabet, this is Class A, GOGL. You've got about 3%. It's not much. And then above that, some price resistance. And right where the line comes in now is price resistance, about 93.86. So That would be my max near-term upside if it's somehow the markets power through and don't break down below those trend lines. If they can go up, talking maybe another 3% before a nice pullback. So, if you are short and you're willing to give it, 3%, upside, drawdown. Don't know if you're going to get a full 6% pullback. That would be a 2-to-1 RR, but you could take a shot here. Amazon. Amazon did hit, and that was my favorite. I made that clear at the time, and that was actually the best performing of the FANGs. Targeted that downtrend line and intersecting price resistance. I have a zone there, 96.50 up to 98, and it's still there. So that's where took profits last week, right there on the trend line, and we're right exactly where I sold that one. So, and I think it's going to go down, most likely, no guarantees. But remember, this was again the most constructive chart. I could make the strongest case for this one because not just the 60-minute chart. Unlike Apple and some others, this one had fallen to, as I pointed out, very, very good support on the weekly chart. This is my Amazon weekly, and that $83 level was and obviously proved to be big support. The buyers did step in there and ramp this one up harder than the rest, and that was whatever it was highlighted last week. And the total run was about 20%. And there it is. It's a downtrend line resistance, very overbought on the 60-minute chart in a bear market. Is the bear market over? Maybe. And if that is, then overbought really doesn't mean that much, or can get a lot more overbought or stay overbought. If otherwise, if we are in a bear market, you get these extreme overbought readings on the 60-minute chart, and you see what happened to the stock each and every time that happened. It was at or very, very near a top when you hit these overbought readings. So that's that. And the takeaway is, and I said this last week on Friday, it's again repetitive because we haven't gone anywhere since Friday, the RR is no longer attractive. Now, this is where everyone wants to buy, not me. Maybe a pullback because I can see some potential for more upside. I'll let you know when that time comes. I'm still kind of in that shorter term trading mindset right now. Just kind of see how things play out this week. We'll go from there. And then Tesla. This one was lagging behind. It had a strong chart, at least on the 60, like the others. Big bullish falling wedge there on the 60-minute chart. Positive divergence, beautiful. Big divergence, clean, breakout, rallied, took out the first resistance level just above the trend line at 114.62, ran right up to that 122.62 target, consolidated, as I pointed out last week, and then boom, there's that breakout this morning. That's where I got price alert. And so that's bullish. And the way it works is support once broken becomes resistance. Once broken becomes support. I'm going to move that line up. Just keep in mind in future videos, because now I need to always say the charts are dynamic. They evolve and they've changed since I put that line there. Before it was resistance on the way up. And now you can see it fits a little better here. I moved it up to about 123.50. Now, I could have left it where it was. Here's our support on a pullback. There's Friday's close, that yellow line. So this is today's gap. I don't know if you can see it in the video. There's a blue line. So there's today's open. So this is the gap. And the way it works is on a pullback, well, buyers often come in by the top of a gap. But a gap once entered is usually backfilled. So that would take you back down to about where I had the line originally, about 122 or so. And also add in the fact that the powers that be, the market maker, this market's full of whipsaw signals and whipsaws when you pop briefly above a resistance level only to reverse back down or go back down below a support level. That's why. So if you are planning to, let's say, for example, buy Tesla at the top of the gap and scale down and add on a pullback to the bottom of the gap, you wouldn't want to have your stop just right below. You'd give it a little bit of room, maybe even wait to see a couple 60-minute candles. And then, if it takes that level, then the bottom of that range is still support. But it wouldn't be ideal to see Tesla re-enter that trading range, because once you re-enter a trading range like this, I've talked about this often, you usually head back down pretty quickly back down to the bottom, because that proves that, or means that this was a failed or false breakout. So, but there it is. Still maintain, the next target. Again, not so crazy about it. I wouldn't add to it here. But if the market can continue up, 136.34-ish, and a maximum target. To me, a get out of Dodge target and probably turn around and reverse short if it gets up here 167.53. So Tesla, that would be a heck of a run. But remember, Tesla has much more higher beta, even though it's one of the largest in the NASDAQ 100 now. Uh, it's still it moves a lot more percentage terms. It's already rallied about 27%. If it gets up to 167.50, it's going to be about a 62% gain. So we'll see if and when it even gets there. Otherwise, remember, we are in a bear market, and what bear markets do is they give you these sometimes these beautiful, nice looking setups, especially on the shorter term time frames, the 60-minute charts and whatnot. And just as they start to play out, break out, and all the bulls figure it's safe to come back in the water and jump in, that's when it burns them. So, like I said, when I'm trading, long side trades in a bear market, I'm driving with one foot on the gas, meaning long there, but also one on the brake, ready to, hit the brakes, get out, and or reverse. Never fall in love with a bear market rally. But anyways, there's that downtrend line. If Tesla can rally up, I gave you already a hard price level that was higher, but there's a downtrend line that may also come into place. And I should have covered when I was on that QQQ60 and after covering SPY, I should have covered NQ. No change there. This is the NQ 60-minute chart for you futures traders. Remember, I laid out 5 targets. All 5 were hit. T1 hit here. T2 check. T3 actually check on the same day. T4 and then T5, and that's that same comparable resistance. And so I'm going to do what I did earlier with QQQ and give you the comparable trend line. It fits a little bit better on the Qs. I don't have a very clean up trend line, but that's it roughly. Either way, we're at price resistance, negative divergence, bear market. So to me, I'm staying short for now. All right, I told you some of the other things. I just want to point out, let me just use the ETFs real quick. And remember, this has been, and I think so far I've done a pretty good job at this and in getting ahead of the headlines and the sentiment out there among investors, and that's the inflation trade. Inflation is foremost in the headlines right now. It's what's driving what the Fed does, and what the Fed does drives what the market does. And so if we have any crystal ball, it is commodities. And again, yes, real estate and services and other things also affect the CPI, but we don't have a very accurate real-time indicator. So that's why I hyper focus on commodities, especially energy, because it is a very large component of the CPI, and it trades minute to minute, second by second, around the clock. I can tell you at 3:01 a.m. tonight what crude oil is priced at and what natural gas is priced at, and then at 3:02 I can tell you if they change. Therefore, that's our closest thing to a real-time inflation indicator. And so, we've been able to kind of pretty much predict what the CPI is going to be every month by just looking at where inflation, especially when you look at a broad-based one like DJP, I'll get to in a second. But what I want to show you here is look at this. This market rallied. The recent market, the trend has been down, and the market's really starting to react to that. But remember, I pointed out here, you have this is USO. You have an uptrend line here. It's in a bull market. There's no arguing that, just like the stock market's in a bear market. And so you have these positive divergences, and there's a potential we could get another leg up and even take out those previous highs right there in USO. So we'll continue to watch this, but all I can tell you is, just like the stock market, see, everything's been going up. We've returned back to a risk-on market. I'm going to cover that in a second, but look at this move up in crude oil based on USO is about over 10% in just the last couple weeks there. UNG, it's a trade idea. This one was highlighted at long-term support here recently. Still at that long-term support. So not going up, and doesn't have the impact crude oil does. I'm going to add a trend line, by the way, on UNG. And I'll check natural gas. Well, let me do that now. You have a couple natural gas charts. Let me show you this one. No, that's on another board. There's the March contract. Let me show you the February. That's still the one I'm in. Where is it? Got it here somewhere, and I may have to pause the video to find that. There it is. So, if you stopped out of this one, great. If you want to give it a little room, great. I told you it needs to take out, in the last updates, 390. I thought I had a second. I don't know, sometimes these lines just disappear on this particular charting platform for me. But yeah, there's two resistance levels that need to pop. I had R1, R2, and they're gone now. But that was one of them, that 390.06, 391, we'll call it, and then that 4133. But what you can see is it was it had been in a very strong and powerful downtrend. There was inflation abation. There's a little bit of tongue twister, but you can see the rate of descent has slowed, and that's what these indicators tell you here. See, I'm drawing out the divergence. So positive divergence has been building because the rate of change is starting to shift. The momentum is starting to shift. Now, you can't call this an uptrend yet, but I think it's building some energy here, just like the stock market built some energy recently in a trading range. And if it can pop it, it's not as clear of a trading range, but we can draw a little trend line here maybe. That might do the trick over that trend line there, right there. And all right, so that's natural gas. And again, that one's not going to have as big an impact as crude oil on the inflation numbers, but this one does. DJP, very well diversified commodity ETF, or ETN, excuse me, similar. And it just shows you this one has corn and wheat and soybeans and oil and gas and gold and everything in there, a lot of it. There's the move up recently. So this was our, we've seen inflation numbers coming down recently, stair stepping down, and now we're starting to move back up. And so what you want to watch, if we get a breakout here above that downtrend line, that could be the catalyst for the next rally there in commodities. And I don't know if you can see it here, but let me just show you the what could really send the commodities running. Is we have divergence, and we would if we hit this $31. It's pretty decent support in DJP, but there's so many different commodities in here, you may not hit that to the button. All I can tell you is right now we have some pretty strong positive divergence. That I can tell you factually. This is not an opinion. There's strong positive divergence. And another opinion, or I'm sorry, fact I can tell you is we are in a bull market in commodities by every metric I use. This was a bear market from 2008, early '08, into the COVID lows right there in early 2020. And we've taken out all previous highs. We've taken out the bear market downtrend. So to me, this is early stage, still early stage, relatively early stage bull market action. And so when you have something in a bull market and you have a nice correction, a pullback to support with positive divergence, that's when you want to buy. And so if that happens, it may not be right away, but the more this goes up and the longer this goes up, the sooner or later the masses and the media are going to get the memo, and they're going to start pointing out, hey, we're seeing another spike in inflation, everyone's going to freak out, and then the market will freak out. So it's going to work. Now, look, maybe we do this. We do that, then that's bullish. Okay, that's going to be bullish for equities. Could be, there could also be, some point. Remember, a lot of damage has been done. We've had many things. Cryptos blow up. We've had quite a few hedge funds and even some institutions. So there may be in a bear market. That's when shoes drop. And all of a sudden, if it's an announcement, a big pension plan in trouble or something else, I think that's a shoe to drop coming in the coming years. Multiple pension plans. Anything else, institutions, I've talked on this ad nauseum, how the big banks and the big financial institutions, they all got their hand in the cookie jar. They just couldn't resist getting into crypto, and most of them at the worst time, before the crypto bubble popped. I'll get to crypto in 1 second, then I'll wrap the video up. But I just wanted to say that, if we do get a powerful leg down in the stock market, it could be from forced liquidation, panic selling, and that could drag commodities down. But trade everything on their own chart, on their own technicals. This to me is the most likely scenario. We get another leg up in commodities, and then sooner than later the market gets the memo and takes its next leg down. But what I wanted to show you, I'm going to loop back to the equity markets, guys, but not the charts. You might have seen enough charts on SPY and QQQ. The VIX. This is my daily chart of VIX. The VIX works sort of like an EKG. You have these spikes. These spikes are corrections. Stocks tend to fall a lot faster than they rise, and the VIX has predictive value, in my opinion. It's not just a random EKG. It's like an irregular heartbeat, obviously, because these pops don't come always on perfect intervals, but you have downtrend lines and then you break out. Downtrend line, breakout. What I wanted to show you here, we did have a breakout recently, and a couple, month or so back for a while I was highlighting this pattern of these downtrend line breaks followed by an area of consolidation, little circle, and then a pop and the next big move up. These were the big drops in the bear market so far, these big spikes. And then one thing I said a couple weeks ago, I said one of the problems I have with this, and I said this right before I flipped from short to bearish at the lows in the equity market. I said quite often by the time you recognize a very clear pattern and it becomes obvious, at least to me or maybe to most, that's when it stops working. So, like I said, it's whatever reason, I told you the reasons I shifted mainly into all longs a few weeks back was the what I was seeing on the equity charts. However, I want to point this out now. What happened since then? So we didn't get a break above this range. We dropped below it this time. So it was a little bit of a change of character. And again, that's also what gives me a little bit of pause, on the bearish scenario that, hey, we had a clear pattern of trendline breakouts followed by some consolidation, back testing, and then boom. And now this is a little bit different. So that gives me just a little bit of pause on the bearish scenario for now. However, let me show you this. Probably covered it before it happened. I showed you this uptrend line here on the daily chart. Here's our uptrend line. This comes off the June lows, June of 2021 in the VIX. And so boom, 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 several reactions, and then we hit it on Friday of last week, and then boom, popped up today. And it also was not just a pullback to support, trendline support and price support. You can see I have a level here. This is a support zone. I just boxed in blue. That was those lows, that low. So it's more of a zone. And the uptrend line, and then look at this. Big old positive divergence on Friday, and then the VIX is up today. So remember, the market has been positive most of today, but yet the VIX didn't get the memo. The VIX buyers are seeing something else. So there's something else going on. This is a bullish setup right here. And so what this tells me is there's a decent chance. That's why I'm staying short overall in the indexes, net short. Only hedge I have to the Qs or that Tesla position, and I may throw that away because what I think is going to happen is today's pop above 280 in QQQ and the rally into the S&P 500, the 200 days, is going to cause a pullback. The pop above 280 is going to fail. We're going to get those near-term pullbacks, and then this can play out. Now this is a pretty big. This would play out for more than a pullback to that minimum target I gave you on the 60-minute chart of QQQ. Should this play out, and that's the divergence line. There's a positive divergence. This could play out for quite a bigger move. So that's it, guys. And it's, I'm saying this can happen, that can happen, and it's true. And the thing is to react and watch it. So if you start to see, the VIX continue to move up, it's going to firm up this divergence right here. And then if you see QQQ break, here's what I'll be looking at. You see QQQ break the trend line, break 280, moving down here. And the buyers either don't step in on 274, 275, or they do, and then it gets sold into and we go on down. Then watch this. If and as each of these support levels are smashed and taken out, especially down here, this market, let's just say maximum that 267. Remember these ranges I had for you back here, the yellow and the purple? That would be the maximum pullback. If the market drops any more below those, especially QQQ, that's probably going to be it. We're probably going to get a big flush out, and that VIX could really run. Otherwise, like I said, this is what I've seen in the last few weeks, even including today and Friday. The fact that we didn't get rejected harder off 280. We had the first initial rejection. They stepped in and bought. Now they're above it. So what I've seen in the last few weeks has been nothing but bullish. And if we don't get a pullback to 274.81, we keep going up. I'm going to say that's pretty dang bullish, that there are more buyers right now, that the sellers have left the building, and there's a lot of people who want in this market and are willing to buy Amazon after a 20+% rally, Tesla after a 30+% rally. That's what it's going to tell me. So yeah, and then on that whole risk off, risk on thing, you remember I made it very clear, Bitcoin, you're going to get more bang for your buck in Bitcoin and Ethereum as long as stocks are going up. they're going to go up, and and you can see they kind of stalled out. There's a doji in Bitcoin. Back here I laid out, there was our breakout point. I gave you a trend line there, and this was a target there, 111.13 I laid out a couple weeks ago, as well as these downtrend lines, which we've now hit. You can see there's the bull market, the primary downtrend line. I'm going to I'm going to tweak it. Yeah, let me show you why. Let me go to a different board and I'll show you why. Here's how I would draw that trend line right now. Come off the highs in GBTC and catch what I'm doing now, and I didn't have, catch the very top of that candle from that's April 21st on 22, and that's it. There's our primary downtrend line. So as I showed you, we also have some price resistance from there to about right here, and this is a great time, in my opinion, if you caught that Bitcoin trade via GPTC or the futures, to take profits. But remember, it was a very bullish setup. The markets were likely to rally, and as I said, if the markets rally, Bitcoin's going to rally, and it's going to rally more. So the move in Bitcoin just in the last few weeks has been 62%. Ethereum, you have ETHE. Let me go back to the chart I gave you right at the downtrend line. This is the same chart I covered, in the last couple weeks here. Primary downtrend line hit. This is a 10 to me. If you caught any or most of this run, or a good part of it, or all of it, a great time to book profits, especially in these guys, because if you trade futures, they trade, they have more liquidity, and they trade more often than these guys. These guys, I don't even think you can sell these in the pre-market session because they're not listed on a major exchange. That's ETHE, but look at that. There was that bullish falling wedge highlighted just recently. There was the breakout, and this little sucker's run up right into the downtrend line, and price resistance has been about a 73% run, and that's because it's a risk on market, because stocks are going up. And so these armchair traders, the apes they call them, look at AMC running up too. They're buying the meme stocks, they're buying crypto. It's late 2020, 21 again, only for a while. But you look at this chart. This is a bear market. There's nothing remotely close to this. This is what a bear market rally is. And in percentage terms, 61% rally might sound huge. It's minuscule as far as a total retracement of the move, and it hasn't done anything to change the technicals. There's massive resistance right here. If AMC wants to run up about $9, you have that big price resistance right there. You have the previous reaction high, and it could, if the market's going to rally, this little stocks like this, they're full of short interest, and then they get the the meme crowd that wants to get him. It's a momentum trade. But I just wanted to say that's back, but like crypto's at resistance, the markets are at resistance. Great time, in my opinion at least, to take profits on longs. If you didn't do it on Thursday or Friday, take some profits, or at the very least raise your stops to protect profits and let it run if you think we're going to continue on up, because that's certainly a possibility. All right, let me wrap it up here. Went a little longer than I thought, but that covers what I'm watching. And if anything changes, I will get my thoughts out to you ASAP. This has been Randy Finney with Right Side of the Chart. Have a great day.